You might think taking bigger positions could be more profitable. This is technically true, for one trade. But trading isn't just one trade. This is a survival game. And the more aggressively you play survival games, the faster you die. The cautious player, the one everyone calls slow, too scared, too conservative, is the one still standing when everyone else is gone. And in trading, the last person standing wins everything. Because trading is a survival game. Here's something nobody has told you about position sizing until today. This shouldn't be about maximizing the profit you can get per trade. It should be about maximizing your probability of survival, your chance of staying in this game. These are completely different things. One is a path that excites you, raises your pulse, increases your stress. The other keeps you alive. And trust me, staying alive long enough is the only way you can truly become wealthy. Not by turning the corner in a single trade, by not getting pushed out of the game. Math is brutal, but we can make it work in our favor. This is quite possible, and the markets don't even care how confident you feel. If you risk more than necessary, your probability of taking damage you can't tolerate will increase that much more. Let's be honest first about why taking big positions feels so appealing. This actually has nothing to do with stupidity. This is impatience disguised as logic. You see a trade opportunity, your criteria say this is a trade worth evaluating. According to your win rate, this trade has a 62% chance of winning. 2-to-1 reward ratio exists. You risk $100 and gain $200 profit. You think this works. And instead of being satisfied with this and continuing, your brain does a calculation. If I risk $100 and make $200, if I risk $500, I'll make $1,000. Same trade, same analysis. 5 times the profit potential. Why wouldn't I do this, you ask yourself? Taking small risk now feels like leaving money on the table. It feels like you're not taking trading seriously, like you're making moves that are too safe. And making safe moves feels like the opposite of being profitable. Your brain is actually slowly preparing you for the scenario likely to destroy you. It's in the persuasion phase because you're not patient enough. You're overconfident in yourself and you want to climb the stairs quickly. With time, not immediately. Everyone thinks like this at the beginning. Frankly, this is completely natural. After all, you didn't start trading to make $50 a week, right? You started to change your life. And changing your life requires big moves, big risks, big rewards. Small position sizing feels like walking slowly when you should be running. It makes you feel weak, like you're a coward, like you don't really trust your edge, that's why you're not taking risk. Yet your brain is planting seeds to deceive you. That's actually what's happening. That's the logic, and it's wrong. Not because the math per trade is wrong. The part you need to think about is this. You're not making one trade. You're making hundreds of trades. And over hundreds of trades, big position sizing doesn't maximize profit. It maximizes your chance of complete ruin. And actually, even though you know this, you think this won't happen to me. Luck will be on my side, deep down. But most of the time, it doesn't work out. Let's continue with a story that explains this situation better than theory. There are 2 traders. Both have completely the same strategies. Back-tested, proven. 60% win rate exists. 2-to-1 risk-reward ratio. Math tells us this strategy can print money. Both traders start with $10,000. Both apply the strategy in a textbook perfect manner. They're not taking emotional trades. They're not violating rules. They're disciplined. There's only pure execution. Everything is progressing flawlessly. The only difference between them is their position sizing. Alex risks 5% per trade, gaining $500 profit. Jordan risks 1% per trade and gains $100 profit. Everything else is the same. Their strategies are the same. Their discipline is the same. The markets they trade are the same. They continue this way. First month, both are progressing well. No surprise. Alex manages to hit TP 3 times in a row, gains $1,500 profit, manages to grow his account by 15% in 3 weeks. Jordan wins the same 3 trades, gained $300 profit, grew his account by 3%. Alex feels really amazing. He thinks this is working. Taking 5% risk feels perfect and brings fast growth. Finally, I'm really making money, he thinks. Jordan feels good but slow. $300 doesn't feel like much to him. He starts thinking maybe taking 1% risk might be too little, says maybe I need to increase my risk to speed things up, but he doesn't break his discipline and continues taking 1% risk. Afterward, a losing streak begins. Stops start coming consecutively. Not because the strategy broke, of course, because this is the nature of this business, because losing streaks are mathematically guaranteed in any system with a 60% win rate. You'll lose 4 out of 10 trades, and sometimes those 4 come in a row. In fact, to be more assertive, those 4 will definitely come in a row, because probability doesn't care about your feelings. So what happens next? Alex loses one trade, down $500. It hurt, but he can handle this. He'd been profitable for quite a while. Second trade stops out, another $500 loss. Now his total loss is $1,000. Account at $9,000. Lost the third trade too. Dropped to $8,500. Fourth trade stopped out. Account at $8,000. Alex lost 20% of his account in 4 trades. He'd started at $10,000. Now at $8,000. And he didn't just lose money, he also took psychological damage. Can he walk this path with the same discipline and risk now? This is an important question. Could you walk it? What would you do in this situation? Getting back to $10,000 from $8,000 isn't possible with 20% gain. 25% gain is needed. Recovery math is always harder than loss math. Starting with high risk looked like an advantage, but in the scenario where things are going well, and we usually only think about the scenario where things are going well, this is what deceives us most. Operating based on the good scenario. Jordan experiences the same 4-trade losing streak, took completely the same trades. $100 risk per trade existed. After 4 stops, his total loss is $400. His account dropped from $10,000 to $9,600, 4% down. He's also in pain, but this isn't devastating pain. It's tolerable, and it doesn't have a traumatic effect. This is a critical difference. Jordan's psychology is fine. Losing $400 over 4 trades feels normal to him. It feels like something that could happen. He thinks I can handle this. Because his strategy says 40% of his trades will stop out. This is expected for him. Jordan continues taking trades that match his system. No panic happened. He's not doubting. Didn't feel the need to question his system. Just continues following his rules. As it should be. And the biggest reason he can do this was that his losses didn't destroy him. Not in terms of trading account, mentally destroy him. He could stay alive. He continued making healthy decisions. On the other hand, Alex is in a bad psychological state. Lost $2,000. His account shrank 20%. He started questioning everything. Absolutely everything. Is my strategy broken? Did I apply it wrong? Should I risk more on the next trade to recover faster? Because the $2,000 loss wasn't just money. Alex also took emotional damage. Taking 5% risk looked smart on paper when winning, yes. Now it feels very illogical. Feels reckless. Alex doesn't blow up here, but he's in a psychologically fragile state. One more bad streak comes, and his account is nearly gone. Jordan's account is still in much better shape, can very easily tolerate multiple losing streaks without breaking. This is exactly the difference 5% risk versus 1% makes. Completely psychological. And in this game, psychology means everything. Don't forget this. Not in the wins. In survival probability during inevitable losses, both as an account and psychologically. Could you recover that account after such psychological damage? Have you ever experienced something like this? Let's fast forward everything a bit. So what happens after 100 trades? Both traders had 60% win rate. They had 2-to-1 risk-reward systems, and they applied their systems perfectly. 60 wins, 40 losses, exactly as their systems predicted. What's Alex's account condition? Sometimes way up, sometimes way down. His account's volatility level is insane. After 100 trades, Alex's account is at $11,000, 10% total growth. Risked 5% per trade for 100 trades, and his total profit is only 10%. Jordan's account? Steady climb, small drawdowns, nothing too dramatic. After 100 trades, his account is at $17,000, 70% growth. By taking 1% risk per trade, he easily surpassed the returns of a trader taking 5% risk. So how? The answer is obvious. Compounding. When you take small risks, you create the chance for yourself to survive long enough for the compounding effect to work. When you take big risks, drawdowns kill your compounding. You spend half your time recovering from losses, not building on gains. There's a big difference between them, and you get rewarded for continuing with that small risk you look down on with discipline. Moreover, you do this with lower stress levels and often even bored. On the other hand, those taking high-risk experience different ups and downs every day. question themselves every day. Think about whether trading is for them, poison their life. You, by taking low risk even if bored, experience much less stress and make money. At the end of the day, don't forget why you started this work. You didn't start for more stress and psychological damage. You started to regularly gain profit from the markets and live a better life. And ironically, the way to do this is through taking less risk. So what percentage risk do you usually take? Let's continue with the math everyone ignores. This is called probability of ruin. Every position size has its own probability of ruin. This is the mathematical chance of your account blowing up even with a winning strategy. What happens if you risk 5% per trade in a strategy with 60% win rate? Your ruin probability over 500 trades is approximately 35%, meaning even with a winning system, just from normal variance, you have a 1 in 3 chance of complete account destruction. Let's assume you risk 1% per trade with the same strategy. Your ruin probability for this scenario is near zero. Your chance of your account completely blowing up is less than 1%. Same strategy and same win rate, different position size, brought different survival rates. And as we said, survival is everything. Because if you're dead, compounding effect can't work for you. You should plan on not getting pushed out of this game, not on gaining more profit. Because when you focus on more profit, you ignore bad scenarios and things that could work against you. You evaluate things with unrealistic optimism, not within the framework of logic and probability. And this can be fatal for your account. Have you ever blown an account due to unrealistic optimism until now? Let's continue with a very accurate example. Casinos always win because of this math. They make all their plans around this math. They don't win because they're smarter. They're not luckier either. They have the smallest edge and the biggest bankroll. Their position size relative to total capital is incredibly small, microscopic. They can survive after infinite losing streaks because each individual bet remains much smaller compared to their reserves. Let's say you enter a casino with $300. Let's assume you bet $50 per hand. You can tolerate 6 losses before blowing your account. But on the other hand, the casino has millions. They take thousands of dollars in bets per table, but this is a risk equal to 1% of their total. They can survive 10,000 losing hands. So in this scenario, who do you think wins? You or the casino? Better strategy doesn't win. Better survival probability wins. Markets work the same way. Trading works the same way. Small position size means big bankroll relative to risk. You become the casino. Big position size means small bankroll relative to risk. You become the gambler. The difference between them is this clear, and everyone knows that gamblers eventually lose. The house wins. Let's talk about what actually destroys traders with big position sizing. It's not just the math, it's psychology. When we risk $500 on a trade and we lose, this isn't just $500. This means emotional overwhelm. Emma trades Forex. She risks 3% per trade. A reasonable sounding risk, not crazily aggressive. Her account is $15,000. 3% means $450 risk per trade. She takes a position on EUR/USD. Setup looks perfect. All criteria met. Goes long. Price immediately drops afterward. Down $200. Hasn't reached her stop level yet, but close. Heart rate accelerating. About to lose $450 of real money. That's a car payment. Her brain starts negotiating. Maybe my stop point is too tight, she thinks. Maybe I should give more room, she says. Price drops more. Down $350. She moves her stop. Just a bit. Gives more breathing room. Can't let this stop out for the full $450. Price keeps dropping. Reaches original stop level. Blows past it. Now down $600. Panic starts. Closes the trade. Because she couldn't accept the original loss, she lost $600 instead of $450. Because it was above her 3% risk tolerance, it affected her decision-making process and turned into 4% actual loss. Let's compare this with Nathan now. He's also trading the same setup, same market, same entry level. But Nathan takes 1% risk. His account is also $15,000. 1% means $150. Price drops. Down $70 loss. Hasn't reached his stop point yet. Heart rate normal. Total $150 risk seems manageable. Feels normal. Price drops more. Down $120. Stop is close. Not panicking. He'd already accepted he could close this trade at a loss. $150 is the price of finding out if this trade works. Price reaches stop point. Trade ended with $150 loss. Closes his computer and continues with his life. The dollar amount he lost was small enough not to break his psychology. So he didn't negotiate, didn't move his stop point. Clean execution, that's all. Taking 1% risk allowed him to act rationally. 3% risk made Emma irrational. Same trader skill, but different position sizes, and this produces a different psychological outcome. This is what big position sizing does. You're not just risking more of your money, you're also affecting your entire decision-making process this way. When the dollar amount feels significant, thinking clearly isn't possible. You start managing the pain, not the trade. You move your stop point. You close your trade early, or you hold your trade too long assuming everything will work out. All because the number on the screen can trigger your threat response. Your amygdala sees $450 disappearing and starts screaming danger. Cortisol floods your system. Your possibility of rational thinking ends. You become unable to trade your system. You start managing your fear. And this fear causes you to make terrible trading decisions. Small position sizing keeps the dollar amount below your panic threshold, and this is what makes the difference. You can lose $150 and stay calm. Your prefrontal cortex remains in control. You execute the plan. When big position sizing crosses that threshold, $450 makes you feel like you're experiencing real danger. Your amygdala takes control. Execution falls apart. Here's the paradox nobody expects. Going slower gets you where you want to go faster. Never forget this. It might feel like you're going backwards, but math proves this. Two traders. Both want to turn 10,000 into 50,000. Both apply the same winning strategy. First trader thinks, I need to grow my account 5 times. This is a big growth target, so he needs to be aggressive. Risks 5% per trade, goes hard, wins some, loses some. But when losing streaks come, it destroys the compounding effect. 3 years pass, account is at 18,000, 80% growth. Not bad, he thinks, but didn't reach his 50,000 target. Trader 2 thinks, I just need to survive and let compounding work, he says. Uses 1% risk. Boring, slow, but continues taking steady risk. No big drawdowns. Compounding effect works consistently. 3 years later, account is at $60,000. 6 times growth. Went even past the target, so why do you think? Smaller position sizing allowed him to survive through variance. His survival allowed compounding effect to work. Compounding did the heavy lifting. Aggressive trader spent half his time recovering from drawdowns. Conservative trader spent all gains compounding. This is what antifragile means. Small position sizing makes you antifragile. You don't just survive chaos, you also thrive within it. Market too volatile? Trader taking 5% risk is paralyzed, can't trade because there's too scary an environment for him. One wrong move can mean his account takes a very big hit. For trader taking 1% risk, volatility is opportunity. Can still trade comfortably and implement his system without worrying. Stays calm. Small position size gives you freedom. Big positions create prison for you. You get trapped because of the risk you take. You become hesitant to take good setups. Holding winners becomes difficult because you're tense due to your excessive risk. In these conditions, operating your system near flawlessly is almost impossible. Making peace with your stops is hard because loss creates a bigger impact. Small positions give you breathing room, thinking space, opportunity to execute properly. That space is where good trading happens. Here's what you need to understand. Trading is not a maximization game. It's a survival game. The goal isn't to win the most per trade. It's to last long enough that your edge can materialize over hundreds of trades. Big position sizing optimizes for short-term excitement. Small position sizing optimizes you for long-term survival. And long-term survival is what creates wealth, not individual big wins. But the ability to keep playing the game while everyone blows their accounts and quits trading. Math is quite clear. 5% risk brings high ruin probability. 1% has near zero ruin probability. Same strategy, different survival rates. And in trading, survival is everything. From today, stop calculating how much you'll make per trade. Start thinking about your ruin probability. How many stops in a row can you withstand before your account blows up? 5% risk? You can take 15 losses and you're down more than 50%. Now recovery from there is nearly impossible and you'll probably reset your account. 1% risk? You can take 30 losses in a row and you're down 30%. Painful, but survivable. You're still in the game. Still compounding. The trader who withstands the most losses wins, not the biggest winner. Because losses are guaranteed. I know winning streaks feel amazing, but losing streaks will definitely come afterward. The only question is whether you'll manage to overcome it. Small position sizing guarantees survival, while big position sizing guarantees ruin. Math is very clear. You don't need to take bigger risks. You need to operate your system correctly more. First, succeed at survival. Then you think about profit. And here's the beautiful irony. What creates the profit is survival. Not taking aggressive risks, not confidence, not bigger risk. Survival. Stay in the game long enough and let probability work in your favor. Aggressive trader flames out. Patient trader 3 years later, 5 years later, 10 years later, has still survived and managed to gain profit and sustain his life. Still compounds, still grows. This is how you win. Not by going big, by going small and lasting long. Smaller position size means bigger profit, not because of one trade, because of 1,000 trades. The math everyone ignores is the most important math. Survival probability will beat profit maximization every single time. Every single time.